Okay, welcome everybody to another Learn It Live webinar for Pepperstone. Today we're going to be talking about beginner scalping strategies for day traders. So everything from the beginning of it all the way to how you can put some of this work in practically into the market. So some of the stuff that we're going to be looking at, we're going to be putting into practical live examples to show you how, I guess, the market reacts in certain situations and what you should be looking at. My name's Thomas Atkinson from FX Evolution. I'm joined, as always, by Ty Annabella. How are you, Ty?
Good, thank you. Welcome everyone to probably one of our favorite topics, being scalping opportunities, especially for beginners who are just starting out. So looking forward to getting in some live examples and showing you how it can all work in the live markets.
Absolutely, Tyron. So, of course, just before we get started today and go through a bit of a summary, obviously a risk warning, the information in this particular video webinar is generic in nature and for educational purposes only. The information does not take into account your personal objectives, financial situation, or needs. And this, of course, should not be construed as an offer, recommendation, or solicitation to buy or sell or trade at all after this period. Now, as we've been talking about quite a lot, Ty, we've got some great trading groups that have been started really quite a few months ago now. I mean, all the way back at the start of the year, and that is the Pepperstone Telegram and, of course, the FX Evolution Trading Discord. The Pepperstone Telegram, if you're not familiar with it, you really need to get involved. Obviously, every day there's great snippets of information about live market information, a bit of a daily kind of update on what's been happening, one of my favorites personally, and of course, updates about webinars that are being hosted or any other thing, including Chris Weston's work as well. So Ty, it's really worthwhile getting involved in these communities. So what are we going to be covering today? Well, a few things actually. We're going to be looking at how to identify scalping opportunities for beginners, of course. We're going to be looking at 3 different things that I think you can bring together or bring basically to your trading analysis to help you spot good trades, but more importantly, keep out some of the chop, keep out some of the things that could act as not being very positive over the long term. Another thing we're going to be looking at is, of course, live chart analysis, what many people are here for, to have a look at the actual markets, to see how we can put some of these technicals into real world application of the major Forex pairs, and of course, popular scalping indicators to keep an eye on. So we'll be looking specifically at 2 indicator types that I think will add a lot of value to your scalping and to your journey when it comes to Forex trading, commodities trading, or any intraday scalping kind of ideas. Then, of course, at the end, we'll have a Q&A with our team. And at that point, we'll be answering all of your questions. So please make sure to ask any questions throughout this webinar, and we'll try to get to those at the end. We always encourage as many as possible when it comes to questions and answers, as if you've got a question, probably another 100 or 200 other people have the same one. So as a beginner, we always want to know about news events. We always want to be aware of these. Now, if you're a scalper, it becomes imperative that you know about these things, specifically red news. So you need to get a economic calendar, and you basically need to be aware of when news specifically to your currency or to the US dollar is coming out. So at the moment, we always say this is one of the most important ones, and that is Fed Powell speaking. And basically when he comes out and speaks at the moment, because of the fiscal policy around the world, this is moving the markets incredibly. So we need to be very well aware of the news events and what's moving the markets. Another thing, what trading pairs are best to start with? We get asked this question all the time, don't we, Ty? So it comes down to the majors, gold, and some of the big crosses, doesn't it? And why is that, Ty? Why do we think that these are some of the best to trade with?
Well, quite often they're the most tradable because there's so many people doing it, and they're the ones that actually work. Most people, like most traders, are actually following patterns and actually scalping the same thing. So you're really moving in line with a lot of the, I guess, the bigger volume, and that makes a big difference. You get a lot less noise in a lot of the bigger pairs, and also you get accustomed to the movements, the general movements of some of the majors as well. So it is definitely the best place to start, especially if you're beginning your journey. But there's plenty of time to move into the cross pairs, but if you can master the majors, the cross pairs become a hell of a lot easier.
So one of the things that I think a lot of beginners often overlook, Tyrone, is the top-down approach or going through multiple timeframes. So usually most people start, let's be honest, all the 1 minute, 5 minute chart traders out there. We all start usually at the 1 minute, then we might go 5 minute, then we might go 15 minute. The reality is that even if you're trading the smaller time frames like 5-minute, 15-minute, 1-minute charts, you actually really want to know what's happening on the higher time frames, as that's where the big traders are. That's where, of course, the institutional bankers are, the hedge fund managers and everything like that. So even if you're trading a 1-minute chart, you might want to go up to a 1 hour and then potentially work your way down through the 1 hour, the 30-minute, the 15-minute to the 5-minute, and understand, more importantly, the price action that's happening in this period. Price action is one of the base fundamentals, or one of the most important things about understanding market dynamics, and therefore being able to recognize great high quality statistical scalping opportunities. So we want to use the top-down approach, which is effectively going from a high time frame down and working through those zones. We also want to be able to recognize trending and range-bound markets. How do we do this? Well, we'll show you a technique tonight. And of course, use line, bar, and candle charts. Don't necessarily fall into the trap of just candle charts like most people use. Line charts and bar charts have their place when doing your analysis. They can also clean up a lot of subjectivity, or potentially just clean up the chart for you to spot great support resistance levels a little bit better. So how do we recognize trends or price action? Well, there's actually an indicator that can help us with this. So we have obviously here an up market where we've got troughs, peaks, and higher troughs. And we have a down market where we have a peak, a trough, a lower peak, and then of course lower troughs. And this is effectively what happens in a healthy trend. Generally, a trend will start, it will have a pullback at some period, then it will have another move, then it will have a pullback, then it will have another move, and then we might see it accumulate. We don't know. But basically, this is a general market kind of thing and a dynamic that happens. Now, you might be the trader that wants to take against the trend and scalp down against this, or you might be the trader that goes with the flow. We usually recommend that you go with the trend. You'll hear this time and time again. The trend is your friend. Hey, Tyrone. How many times have we heard that one? But how true does it ring?
Absolutely true. It gives you a lot of scope for, not getting your entry absolutely perfect, but having the momentum carry into your direction, which is a really, really important aspect of trading. So as much as many, I guess, sayings, a little bit of a fallacy, this one can definitely be, true in most circumstances. Trend is definitely a friend.
So there's two things that we can do to recognize trend. One of those is we need to understand what a channel is. Now, I'll get I'll get someone to post out in just a second a free cheat sheet that shows you some basic patterns that I think are very helpful to day trading, swing trading, or scalping. But that is also how we recognize a range-bound market. We'll talk about that more soon. The other thing is, and what we're going to focus on a little bit more tonight, is moving averages in the direction of trend with role reversal. How do we bring together moving averages, which are a very common technique in the market, something called role reversal, and potentially another indicator a little bit later on, all together to create a multi-time approach. So basically, we're going to look through multi-time frames, and on top of that, we're going to use multiple criteria to prove a point that this is a better statistical chance of working out. Ultimately, whenever you're using technical analysis, you're working on statistics. You're working on the likelihood of something to happen. Now, if you could say every time it will happen 8 out of 10 times, and you will make your $100, you'll turn it into $200, and you could do that 8 out of 10 times, you're going to become rich, right? That's obviously the ultimate goal.
Sorry, Can I just have confirmation? Could someone just post in the questions if they're actually hearing everything okay? I've just had a couple of people say that the sound has dropped out. Can I just have a confirmation? Can someone confirm that they're hearing us okay?
I think it should be fine, but I'm getting one yes. Yeah, it works for you.
Okay.
It could be the web platform. Yeah, it looks like everyone, it's the web platform. If you do have that problem, by the way, please just disconnect and reconnect, and it should work perfectly for you. Okay, so moving averages, Tyrone, why do we use these? Is it one of the most popular beginner techniques? Now, it may seem simple and it may seem like a no-brainer thing to do. It can be this simple, actually, using correct moving averages. However, it's about bringing it all together. It's about understanding moving averages with price action and trend that really brings your scalping, day trading, or swing trading to the next level. So here we have what's called a 50 simple moving average. It's a pretty common moving average that's used throughout all of those different types of trading techniques. the thing is here, we've highlighted a couple of zones where effectively price has returned back to this moving average, and then it's bounced off this zone. Effectively, it's found buying support. So at this point, the market's been doing that thing we described before, where we've got the move up, we've got the move down, the exhaustion period, we've got the next move up, we've got the move down. And this 50 moving average here is actually tracking this particular market. Now, this could be, notice how we don't have a time frame on this. This could be a 5-minute chart, a 1-minute chart, a 15-minute chart, or even an hour chart. It doesn't matter. The same principle will apply. The 50 SMA will apply to that time frame and will become relevant to that time frame. So why is this? Well, we've got two different types of moving averages that we're going to talk to you about today. And one of those is the simple moving average. So Tyron, do you want to explain to everybody why, or what is a simple moving average, and of course, why we do use it?
Sure. So the simple moving average is just basically the average of the periods that you're looking at. So as you can see here, a 10-period moving average just basically adds up the previous 10 bars or candles and gives you the average of that. So that's a simple version. The other the other moving average that we talk about is an exponential moving average, which is an EMA. So the EMA actually adds more weight to the end number. So you can see here, the sliding scale is basically giving a lot more weight to the 3, the 2, the 1, and the 6 than it does the 2, 2, and 1 and 4 at the start. So what that means is it's actually a little bit more price dynamic. It's a little bit faster than the simple moving average, in that it's more reactive to what the price is doing, because it's basing a lot more of its movements on the previous couple of candles as opposed to what was happening 8, 9, and 10 candles ago. So there are ways of using both of them. For us, and a few of the questions have been in there, our most popular moving averages that we use all the time on our charts are a 20 and a 50 EMA. Okay, so the 20 exponential moving average and the 50 exponential moving average, and the 200 SMA, so the 200 simple moving average, just simply because the 200 is basically the 200 periods of whatever time frame we're looking at. So if we're on a daily chart, we're looking at the last 200 daily candles, and if we're on an hour chart, we're obviously looking at the last 200 candles. But the simple moving average is the most consistent for that, and a lot of people seem to use that in the stock markets as well. So we like to stick to that, and there's not a lot of change. There's not a lot of benefit in our mind putting weight on what's happening in the last handful of candles on a 200 moving average, whereas on the 20 and the 50, the speed is important.
So why do we therefore use the faster EMAs, and why are they better for scalping? Well, as Tyrone said, more weight on the most recent price action, on the most recent moves. You can see here the difference between the 20 simple moving average and the 20 exponential moving average. And I know this may sound incredibly simple to many people out there, but surprising how many people don't understand the difference between these two and why it's more important. Now, what we can see here is that the blue line is more reactive to the market conditions. It crosses up faster, it crosses down faster, etc. Whereas the red line is a little bit more smooth. So do we want to use a more reactive thing when we're trading a smaller time frame, we're trading sharp, aggressive moves? We absolutely do. So that's why the exponential moving average is the one that you're going to want to put on your charts. And that is, again, the 20, the 50, and the 200. And would we use these for swing trading, day trading, and scalping? Absolutely. Now, some people will use a 5 and an 8, and they'll use that for scalping. We've found that you get just as great opportunities with the 20, the 50, and the 200. What ends up happening is you get slightly less opportunities, but they are better statistical chances. And remember, when we're talking about bringing together scalping and day trading, especially if you're a beginner, it's about trying to stack the odds in your favor. So another way of stacking odds in our favor is selecting the time of day that we want to scalp, the time of day that we want to day trade. I've already had this question a few times in the room here, and that is, when do we trade? When do we do it? Well, the answer is actually relatively simple. You trade specifically to your currency pairs. If you're in the Asian session, then you trade around market opens and you trade specifically the Asian pairs. So that would be things like the Australian dollar, the Japanese yen, yuan, all of those types of things, gold even. All of those trade very heavily around the Asian session opens. And the Asian session opens really happen around that kind of 9 to 10 a.m. AEST, all the way to 11, depending on, of course, the country that's opening during that time. Now, the other alternative is that you look at maybe Europe. So Europe, you look at, of course, the Great British Pound. We look at the euro itself, and we trade those pairs, and we trade pairs correlated to that at that period of time. And what we want to do is, if we're scalping or day trading, we want to be planning out our trades. We actually want to be in there a little bit earlier. So if you can get in 30 minutes before the session open, then what we can do is we can come in, we can look at the charts, we can prep, we can see the resistance and the support, we can see how the moving averages are, and you need to be ready and prepped. Think of it as the homework that you've got to put in to get the reward out. If you're not ready in scalping or day trading, then the market will move so aggressively that you'll be pulling your hair out saying, I've missed it again. And you don't want that feeling. You've probably had that before, or the worst thing, Tyrone, the entry, because you missed out on the opportunity, the market went up, you were meant to get in down here, and you just go, I'm going to buy here, the market comes down against you, stops you out, and then the dreaded revenge trade, the thing we do not want to do. We always laugh because we know everyone makes that mistake, unfortunately. We've done it, everyone's done it.
Everyone's done it, especially at the start, so you've got to be really, really careful on that one.
So let's take a look at moving averages just to put them in perspective of the markets right now. I think proving concepts is really important to people, and it's especially important when you're a beginner. Can I trust what these things are? Can I use these moving averages? How do they really work? Well, here is the NASDAQ. So this is the NASDAQ index, the NASDAQ 100. This is a daily time frame, I understand that, but we have here a 20 moving average, an exponential. Now, notice along this very aggressive bullish trend that the NASDAQ was on, every time it came down to this 20, it bought up. Too simple, right? Every single time it just bought up. This is what happens during an aggressive trend. And what you can do as a beginner trader is you can spot this by recognizing recognizing basically it happening. So you see it happen one time, you see it happening two times, and then it becomes that self-fulfilling prophecy. The third time, the fourth time, the fifth time, the sixth time. Imagine if every single time you were just buying off this 20 and that's all you were doing. You would actually have an incredibly successful trading opportunity here. Now, it's not as simple as that all the time, but this is, of course, a live market where it has happened. Let's take here an example of the pound US dollar. Now, the pound US dollar has been in a very aggressive short trend. So how do we take advantage of that as a beginner trader? Well, I can see something straight away, Ty. Do you see this 20 like I'm seeing the 20?
Yeah, absolutely. It's all the way down.
We just short this 20 all the way down. Every time it's hit this 20. Now, eventually, of course, it will break this pattern, but notice that it does it multiple times up here. And even if you were in at this point here, or this point here, or this point here, you've got multiple great trading opportunities in the direction of trend. Now, why do you know that this is potentially a good trading opportunity or a good zone? Well, there's a couple of reasons why, and I think it comes to the top-down approach and when we break down the market this way. So firstly, there is a candle pattern here that we're not going to talk about too much today, but it's basically the shooting star. Now, some people know it as a pin bar, and I think if you've got a pen and paper with you and you're not sure what that is, definitely look up shooting star pin bar on the internet. They are everywhere, and understand this. Now, this is one decent candle, and I'll say it's a decent one. It's not good enough by itself, but you'll notice that we have here on the daily, we've got a drawn horizontal line. And why do we have that? Well, we know that previously it found resistance, and a very similar candle pattern actually happened over here. So it started weakening, and then of course it got through something that's been holding. Notice the 20, this red line over here, 20, 20, 20 rejected, 20 broke under. When that happened, it basically signified a huge amount of shorting potential on the smaller time frame. So we've actually recognized that on the daily. Then we can go in the 4 hour, see what's been happening. Well, we got a cross of the 2050 moving averages at the same time. That signifies that effectively the market is shorting or the market is weakening at that point. We go down to the 1 hour and we see that it's in an aggressive trend. Now we can spot all of this really over here. We can spot that we're under the 200 here, which is a green line, the 200 simple, and we can spot that the market is already weakening due to everything else that we're seeing. When it gets through that zone though, then we can go into the smaller timeframes, the 30 and the 15, and actually the 30-minute 20 was almost completely spot on. But I personally, and I think Tyrone would agree with this, we really like the 1 hour, 15-minute charts for the scalping. Specifically, the 15-minute is a decent scalping kind of chart. We don't like the 1 minute that too much, but the same kind of thing will apply. You can see here that this is respected throughout that time frame. So moving averages just by themselves show us opportunity. Let's go back into the slides here and talk about what else, though, we could see from the perspective of this particular type of strategy. What else could we be using as a beginner? So one of those is recognizing the market conditions. Now, we posted into the room, and I think we'll do it again just if you missed it. We've got, of course, a trading pattern cheat sheet, and that trading pattern cheat sheet will teach you a little bit about channeling markets. It'll teach you about what we call a channel or a range-bound market. When a market is range-bound, as in when it has one touch and two touches to each side between two different zones or two different areas, this effectively becomes a market that is not necessarily going to be very good with moving averages. So as soon as you see these two touches to both sides, you stop using moving averages. That's as far as we're going to go into it today. But remember this, you see this, stop using moving averages. Do not use them anymore. Isn't that right, Ty? We do not want to use moving averages in range-bound markets.
No, they're counterintuitive to what you're trying to achieve. Moving averages are definitely a trend-based indicator, but we do have other indicators that we're going to use in sideways markets, and we're going to get to them very, very shortly.
So someone is actually asking a good question here, Ty, and I'm going to go into this just quickly. I know you are doing technicals here, but also knowing that the Brexit no deal is an important fundamental leading to weak Great British pound. Absolutely. We mentioned before that, of course, red news is going to move the market. The key is, though, that you could literally know nothing about that. Okay. Now, obviously, if you know that, that's fine, but it can also cloud your judgment when sometimes the market does the opposite of what you think due to the fundamentals in currency. Currency is incredibly fast moving. So sometimes what is better to do is to actually follow the trends and follow the movements. And also, of course, then understand when the big news is coming out, because the big news can whipsaw the market each way and therefore create instability. However, once that news is out and you see a big move on, that doesn't matter. It doesn't matter so much why it's happening. It's you follow that trend, and then of course you learn how to also take the profit at those zones. I think that will help you a lot, because you will find at some point, and you're probably best remembering this, that you'll see a news event come out and you'll say, that doesn't make sense to what I'm seeing on the price action. How many times do we see that, Ty? All the time, yeah? It happens so much in currency.
That's right, yeah. And look, fundamental, look, you can't scalp. I mean, it's very, very difficult. I shouldn't say you can't. I mean, there's nothing that you actually can't do, but it's difficult to scalp fundamental news effectively, because there's no real time frame as to when or how it will react. Like Thomas said, sometimes what you would expect to send the market one way goes completely differently. And if you're scalping that sort of scenario, you're going to be in all sorts of bother. But when you are taking a sort of a medium to longer term approach, fundamental analysis definitely comes into it. It certainly has its place, but it's extraordinarily difficult to scalp that sort of environment. So yeah, you probably want to be keeping your the scalping type trades to what you're seeing on the charts. What you're seeing unfold is the best way to play that one, because that's really, you're sort of talking about a time frame. Like, you may be in and out of a trade in 15 minutes to a couple of hours, whereas there's no fundamental news that's going to have any backing on that unless you're actually trading a news event, which is certainly not what we're talking about here.
So let's bring two things together now, Tyron. Now, obviously, we're not going to go into too much resistance support, as we do understand that this webinar is time limited. But what I want to bring in is the idea of finding price. Now, remember before we had that 50 simple moving average chart, and we saw that the moving average was reached by price. Now, sometimes what was going to happen is we could have a moving average hovering below. So let's say it does this, and we might have a point which acted as resistance. So let's consider this as a currency. Let's say this currency was trading at 80 cents. It hit 80 cents and it found resistance. Effectively, it found selling pressure. So remember, we have those markets that do this all the time. So what if we had a market where it came up to a point, found resistance, found selling pressure, came back up to the point, found resistance, found selling pressure, and then broke through? The thing is, this 80-cent bracket, this 80 cents becomes a key level. It becomes a point of what we call resistance. And when that market comes back down and touches that level of resistance, that resistance acts as support. Now, if you ever see this kind of area, which you will do once you learn about role reversal and you do this, you might also see sometimes a moving average at the same point. So you may see the 20 or the 50 or even the 200. And we've got an example of this to show everybody a little bit of this kind of going on. So here's the 20, the 50, and maybe we've got the 20 or the 50 here. Do you think that it's a better trading opportunity, scalp, day trade, whatever we're looking at, when we have the moving average and we've also got the role reversal area where the 80 is reached? It certainly is. This is the better opportunity. We're putting two things together. We're using moving averages, which in this case are going to be acting as dynamic support in the uptrend here, or they can act as dynamic resistance. And we're also using price action. We know that this 80 level is a key level. On top of that, because it's an 80 level, we've also got the psychology of that level. So we're bringing together actually three reasons to be in the trade. And that's only just the beginning of things that you can put together into your analysis. Everything that you add to your analysis, though, must make sense. It makes sense the 80 level is going to be key. It makes sense that a market will exhaust and come back to a moving average. And it also makes sense that what was previously resistance or a key point of selling pressure, once it breaks through, will become a key point of buying pressure. All those three things make sense, don't they, Ty?
Yeah, most definitely. And when they do cross over and actually join up and you see all of them working together, it makes a very, very valuable level of support or resistance depending on which way you're trading. So yeah, most definitely. One thing I will quickly just mention too, I know we've had a few people ask about it. The groups that we were talking about earlier, we're going to post them throughout the evening, but just be sure if you're not part of the Pepperstone Telegram group I've posted the link in there. The Telegram group that Pepperstone offer gives daily news updates and any actionable events that are happening that you might not be aware of. It's a really, really good group to be part of. So if you haven't already joined it, be sure to click on the link and be part of that group, because it can be a very valuable asset, especially if you're not looking for events on a daily basis.
Absolutely, Ty. So I'll actually just quickly show everyone what it is. Here we go. Here we have the Pepperstone room, and basically we have over here a whole bunch of information coming out, and of course this is a great thing to be part of. So definitely recommended. That there's over 5,000 people in there now, and it's growing every single day, so you should definitely join that. So here we've got the role reversal. Now, Ty, I just want to say another thing is when you learn more about this, if we have one touch, two touches, three touches, or even four touches to a point, the more significant touches and rejections off this zone, the better the support will be, or the better the resistance will be if it's the opposite way. So I call this the 1, 2, 3, and we'll do more on that throughout webinars. And if you go back through Pepperstone's YouTube, you'll see a few things that we do, but I'll just have a bit of a hint. When you have multiple touches, it's definitely very good. Now, these are some other chart patterns that are worthwhile learning. We're not going into these today, but again, they are in that trading cheat sheet that you can get for free that we're posting in the room, so definitely consider that. Let's go back now to the market and just talk quickly about some other examples that have gone on recently. So one of those is the Euro US dollar. So here we've got the Euro US dollar, and we're on, let's go to a 4-hour chart. So, well, firstly, where we are right now is it's actually coming back down to a previous point of resistance, which could act as support. That's for sure, but that's not really what we're going to be focusing on right now. We're on the 4-hour. Overall, the trend's been down, but it looks like it's kind of reversing a little bit of that. We go to the 1 hour and we can see it's been in a pretty aggressive trend. So was there any spots or any areas that we could have maybe got into? Well, let's go to the 15-minute, one of our favorite scalping kind of areas. One thing that happened here was that we had a market break below what I would consider a pretty key zone. So let's have a look at this. We had previous resistance over here where the market struggled to get through this zone. We got a lot of body closes in the candles here and it got through. Then it became support, as we can see here, where it's found buying pressure, which could have been a scalping opportunity in itself if you wanted to. And then on even the smaller timeframes here would have been more successful though. And then of course we have that close below, this candle here, closes below, and then it comes back up and it touches two moving averages. So it's not so much anything else other than the two moving averages that I want to discuss. We've got the red one, which is the 20, and the blue one, which is the 50. Both of these are intersecting with each other. What that means is that they both act as dynamic support. So if we were going to highlight this area, which we'll do now, we'll put a spotlight on it, this area here becomes very difficult for the market to push through because the 20 and the 50 are respected not only by traders, but also, more importantly, by algorithms. So there are algorithms out there that actually trade off 20s and trade off 50s, just like they did over here. Buy off the 50, buy off the 20, buy off the 20, buying off the 20, that kind of thing. Over here, we have two of them intersecting with each other, and we have some kind of consolidation of the price right underneath that zone where we had resistance becoming support. So it becomes an area that we might be interested in getting into the market. But there's a further thing that we can add together onto these charts that I think makes even more sense to put on, and that is another indicator that we can use. So let's go back to the slides and talk about stochastic. Now, you might be familiar with stochastic. Ty, was stochastic probably the first indicator other than moving averages that we learnt about? I would say it would be close.
Yeah, it definitely is. It's one of the more popular ones. There's a lot of videos on it on YouTube that you've probably seen if you've just started exploring it. And when it's used correctly in the right market environment, it's actually very, very powerful. There's no question about that. But the problem is a lot of people don't know when to not use it, and I think that's probably the biggest issue and what brings most people undone. So what it effectively is, the stochastic oscillator is a momentum indicator that compares the closing price of whatever trading instrument you're looking at to the high and the low range of its price over a defined number of periods. Now, generally that's 14 as a default on most platforms, okay? So it adjusts itself to, like all indicators, it adjusts itself to the time frame that you're on. So if you're on a daily chart, it's going to adjust itself to the last 14 days. And if you're on a 1 hour chart, it's going to be the last 14 hours. But because it's a momentum indicator and it is comparing price to the highs and lows of the range, it can be quite reactive, especially in a sideways market. Now, when you're looking at the overbought and oversold levels here that we've got on display, they're generally the 80 and the 20 are our favorites. There's no question about that. Some people use 70 and 30, but we don't really find them to be deep enough, and it's not really oversold or overbought enough to have a significant impact on what you're looking at. So we like to adjust them to the 80 and the 20. Now, when as you can see, the signal lines are above the 80 line, we consider it overbought. And when it's under the 20 line, it's generally considered oversold. Okay, now here's the thing. When in a sideways market, they're very, very reactive. You can see here that the price reacts very, very efficiently to the overbought and oversold zones. When it's overbought, it generally does come down. And when it's oversold, it does start to creep up. The danger is, and this is what brings a lot of people undone with the stochastic indicator, is that they don't recognize when a market's out of a trend and it's actually broken out of a zone and into what is considered a trend. Now, when the market is trending and trending heavily, the price or the indicators can actually go into the overbought or the oversold zone if it's in a downtrend and stay there for a very, very long time. And a lot of people find themselves fighting it and trying to actually sell every time it's in the overbought. And that's fine in a sideways market, but in a heavy trending market, they can stay above the overbought for a very, very long time, and that's perfectly normal. And that's why this indicator is not efficient at all in a trending market. Okay, so when using the simple this simple strategy for stochastic, it is basically as simple as selling in the overbought zone in a sideways market and buying in an oversold zone also only in a sideways market. Very, very important to identify, though, that you are in a sideways market. I can't emphasize that enough, because you can see a lot of this working out for a long, long time. And then if you start to fight it when the market's trending and you haven't identified the break, it can be punishing to the extreme. So as you can see here, the default settings on the stochastics are generally 70 and 30. So if you want to adjust those, maybe we'll even show you how to adjust that. Can we just do a quick properties, and we'll just show you how you can simply adjust those lines. And okay, you go to the levels there, you just change that to 80 and you change that to 20, like so, and that makes them, so it's an oscillator, so it goes between the ranges of 0 and 100. Okay, so anything above 80 is considered in the overbought, and anything below the 20 is in the oversold. A golden indicator, and very, very useful and simple to use in a sideways market.
Another way you can use it, though, Ty, in trend is potentially looking at just one direction, isn't it? So basically, if we're in a shorting market here where the market is selling off and it pulls back, now it's not always going to happen, but sometimes you are going to see it, where the stochastic actually becomes overbought but the direction is down, you can use it as a further confirmation when you hit something like a 20. So you can bring that together, can't you?
Yeah, you most definitely can. Generally, though, like it's rare that you're going to really get really good signals on it, but when they do appear, definitely jump on. I mean, you can see here you got a downward trend. You got a little mini double top in the direction of the trend on the 20 moving average. You can see the stochastic, just touched the 80 line, and and then down she went. So you can see it right there. You can see the stochastic didn't quite get into the overbought zone, but it got very, very close. But you've got the 20 moving average giving you the extra confirmation that you need.
Yeah, so I think when you're bringing things together, we've covered a few topics today. So one of those is that we can use moving averages. Now, again, we get asked it constantly here. So we've got the 20, which is the red one, exponential, the 50, which is exponential, and the 200 simple. Once we've identified a trend, which we can either do by literally just looking at the bigger time frames, coming down, looking at the price action, and then spotting potentially the 1-2 in terms of the 20 being respected multiple times, we can then bring in the next element of that. So that could be that we want to see role reversal. It could be that when it breaks through something like this key support over here, that the market actually comes down, comes back, hits the 20, and then we maybe at the same time get overbought stochastic. When we get all of those things together, we've got 3 amazing reasons. Now, as Tyrone mentioned, you're not always going to get the stochastic because of the nature of the aggressive trend. Sometimes you will. It's a bonus point. Think of that as the better trade. When it happens, that's bonus.
Yeah, correct. Yep, correct. I am going to address one thing. Look, I've had a lot of questions in here about the exit points and also where you put your stop losses. So it's a very valid question. When you're scalping, where do you put your stop loss and where do you put your take profits? And also, I've got a question that kind of leads into this, that if you were trading on a 15-minute chart, do you keep a position open overnight if the trend is reasonably strong? That all ties into what we're sort of talking about here. The simplest way to approach placing your stop losses and your take profits on a scalping type trade is always aiming for the first support or resistance zones in your direction. So if you're shorting, what you're looking for is generally either a touch of a moving average that's going to cause some pain on a bigger time frame, or the first serious support level that you're looking at. So it could be a round number, or it could be and well, we can give you a little bit of an example here. So you can probably let's do an example on.
Well, there's a few things that are going on here, I think, and that is the pound. So if you were shorting the pound, when we're looking at it and it gets through that zone and we start taking sells in the smaller time frames, there's really only a few key areas, and it's been such an aggressive move up that it suddenly doesn't have that much market structure on the way down. I can certainly see why it's so aggressively moving here. If we look and we scroll over, the beauty of the top-down approach, as Tyrone mentioned, is that we go from a larger time frame down, and what we want to do is we want to identify key levels on the larger time frame, and then once we've done that, we have key take profits for our scalps. Now, what that will do is it'll allow us to have way larger take profits, but be realistic about those take profits because we're trading in the direction of trend. We're kind of racking it into your brain a little bit tonight. Trade in trend if you can, and then you'll get larger profits and larger rewards. The problem with most scalpers is that you'll get in, you'll take 3 pips and you'll say that was great. The nature of a scalp is, of course, to get in very quickly. I believe, and I guess Tyrone does as well, that scalping is not the same as it once was. You've got a lot of algorithms on the 1-minute, 5-minute charts. So when you're trading the 15 minutes, if you can identify these next zones, and then you can say, okay, on the 4-hour, we think it could go to this 129, 130 area. Well, it makes sense. 130 is a psychological number, exactly 1.30. It's a 10-cent increment in currency. So maybe what you want to do is you want to say, okay, well, I think it could get to the 130. And we'll notice here when we zoom in, the 130 just above it actually had some bullish movement, which wouldn't have been that nice for our little scalp on the way down. Let's say we're in over here. We don't really want that. So the 130 would make some sense, and often you'll have price structure around that point where you'll have other previous supports or other previous resistances around those key levels. So always pay a lot of attention to the psychological number and pay a lot of attention to the previous price action on something like a 4-hour and a 1-hour, even if you're trading the 15-minute or 5-minute charts. I think that probably answers a little bit, Ty, but do you have anything to add to that one?
Yeah, it does, and that makes the most amount of sense. And we love going for those key levels because they're the ones that the market does gravitate to. Now, stop losses are simply just placed above the previous swing. So if you're going short, you put your stop loss above the previous high or the previous mini swing high, and if you're going long, it's between you just put it below the previous trough. It's a fairly straightforward process, and they've got to be fixed and hard and fast. Scalping does involve a lot more trading than just a normal set and forget position, so you want to make sure that your stop losses are placed right with the right risk management, most definitely. Now, look, I've got quite a few questions here asking about particular pairs. Can we look at them and apply this analysis? We can't do that now because we're obviously this is a teaching webinar and we're just trying to teach the concepts. But if you're interested in looking at pairs, some have asked about the dollar index and gold and also the indices. We're going to do that in the next webinar, which starts in about 20 minutes. So I'm going to post a link in the chat room. So if you haven't already registered for our webinar in 20 minutes, just jump in that one, and we're going to do all of the analysis on everything that basically everyone's asked for here, and apply some of these techniques that we're looking at here. So that's just being placed in the chat window now.
So we've got a whole bunch of questions here about stop losses, take profits when scalping, all of these types of things. Think about adding the extra element that we're not adding right now, and that is, remember before we said shooting star candle. Now, if we had a shooting star candle here on the way down, and we also had, let's say, an overbought stochastic, and we had the 20 EMA and all of these types of things, think of it this way, as you could place the stop loss just above this. Now, do we want to place it 1 pip above this? No, we don't want to do that, because that basically is going to be a stop hunt. What you want to do is you want to look at the candle length and you want to add a percentage behind. The percentage behind is the element that changes it. It becomes market dynamic. Just like a moving average is dynamic, another way you can track is you can change a moving average potentially that hasn't been hit along the trend. So maybe that's a 30 EMA. Maybe that's a 40 EMA, some strange EMA that you're looking at. You can therefore use that as a form of trailing stop. If you don't have what Tyrone said before, which is effectively a price action based stop, like here we have market structure. So market structure equals, we can place our stop loss above very clearly, especially when it breaks below. Then we get more market structure on the smaller time frame, you can place it below. Then we come down here, huge amounts of market structure, you can move it below. That's the way you want to do it. Move it behind the structure as the structure forms. That's something that you're going to come with experience, and it's going to get easier with time. So very, very important there when it comes to scalping as well. All right, let's go back here just quickly, and I'm going to answer a question just quickly here as well, Ty, which is what about using VWAP? So I know VWAP's a popular indicator. We will be doing a webinar about it soon, and VWAP can definitely be used in scalping. We're not talking about it tonight because I think it can complicate stuff as well. So we do want to make sure that we're using these particular methods, but VWAP is also one of those ones that you can use for scalping. So I understand that. What other market conditions do we look for? Well, of course, key red news, non-farm payrolls is pretty much a no scalp event. It's basically gambling. I think so anyway. You get big market swings each way. I encourage you to definitely watch a non-farm event live. And why is that? Because what will happen is the market might go up really quickly, and then it will go down super quickly, and then it will go up super quickly, and it may actually end up in the same place as it started. And that's because of the nature of the event. So definitely understand that. Types of market conditions, types of volatility. Check out something called the VIX, which is in the Pepperstone platform. Very important to look at. That's the volatility index, and that shows you really the aggressiveness of the market currently. Now, obviously, we saw a huge amount of movement through March. We're still in a very volatile time, and therefore we're getting bigger moves. Risk management strategies we talk about all the time. I'll skip over it a little bit. No more than 1 to 2% of your capital if possible, and try to target 1-to-1 plus risk reward ratios. No 0.5 to 1 when scalping. It doesn't matter if you have an 80% win rate, it's not good. You want to try to get 1-to-1 whenever possible or better. So that means if I risk $100, I want to make $100. If I risk $10, I want to make $10. Ideally, that's what you want. Obviously, don't FOMO. We mention that quite regularly, and we'll be going over to a bunch of questions right now, Ty. But another thing I do want to mention is that if you've enjoyed some of this webinar today, well, firstly, we do definitely have a 50% off offer exclusive to Pepperstone members. So we'll pop that in the room if you're interested in finding out more about our trading courses. But also, I would ask you that at the end of this webinar, we do have a survey. So if you found some of this information important or interesting or helpful, definitely give us some feedback on that. So just a quick thing on this Trading Essentials discount. You basically get our Trading Essentials course. You get private access to our Discord trading community, which has hundreds of members in it that are trading Forex, commodities, all sorts of things all the time. And also a Monday, Tuesday, Wednesday, Thursday, and Friday analysis of the markets. And that's excellent kind of coverage. We've been doing this for a long time, and you even get our webinars all the way back. So not these ones. These ones are definitely available free on Pepperstone, but we've also got our own live market series as well. So that's really cool. Let's hand it over to a few of these.
We will. Sorry, I was actually going to say that we've had a lot of people ask about the recording of this webinar. All of the Pepperstone webinars are recorded, including every one we do every fortnight. So you'll find them on the YouTube channel basically in the morning. It's usually around 10 or 11 a.m. So the replays are always up. And then you can also go and explore some of the ones that you may have missed previously as well. So they're always up there for you. But as a general rule, the ones that we do on a fortnightly basis will be available to you the next day on the Pepperstone YouTube channel.
So we've got a couple of questions here, Ty. I think it's always interesting to answer questions. I know many of them have been answered throughout by the staff members throughout the webinar, so that's excellent. Which timeframes would you use for scalping? 5, 15, 30 on the lower timeframes, and then 1 hour, 4 hour for the higher timeframes. So the 1 hour, 4 hour are really giving you market structure, and they're giving you the dynamics of the market and potentially the take profit levels. Learn about support resistance, learn about where the moving averages are in the higher timeframes as well, as all of those can act as barriers for your scalp. So when you're scalping in the direction and you see maybe a 200 simple moving average on a 1 hour and you're about to scalp into that and that's 25 or 30 pips away, you might want to be worried about that zone because it can definitely damage your scalp. So you need to be aware of the higher timeframes. What we're trying to say is be aware of the things on the bigger timeframes because it matters. That's it. So we suggest 15 minutes is a very good time frame to be looking at scalps and good structure. You get a lot less fake outs there. If you want to apply the same methods we talked about tonight on the 1 minute, 5 minute, you certainly can. Are you able to do some analysis on the S&P? We will be doing that in the next video, so you can absolutely check that out. I use US dollar index charts to predict the direction of a market on the US dollar pairs and part of the US dollar news and drives gold? You certainly should be looking at the DXY. So the US dollar index is on the Pepperstone platform. We highly suggest you look at it and you learn the technicals on that. And the great thing is for a scalper or day trader is you can use dollar index, identify key breakouts, identify key trends, and then follow those trends on Euro US dollar, on pound US dollar, on any of those types of things, as they'll all trade very similarly against the trend. So dollar index worthwhile. And there's all these other questions here, and I think a lot of them have been answered. So that's really good. All right, well, Tyrone, do you have any other questions that you want to get answered here?
Yeah, look, like I said, we've got a lot of questions about looking at market analysis coming through. Next webinar, team, so in 12 minutes time, I'll post a link in there again in the chat room. If you haven't got it, just PM us and we'll get you the link just quickly. But look, for the most part, it seems that a lot of the questions that are being asked, it seems there's a little bit of confusion about the Pepperstone channel as well. A few people didn't realize there was a YouTube channel, and there certainly is. Just look up Pepperstone when you go into your YouTube search engine, and it's got like a whole heap of webinars of all the ones that we've done, and all of the analysis from Chris Weston and the market ahead. There's a lot of very valuable information there, and a lot of what people are asking here, you'll actually find in the webinars. A lot of the times we've actually done Learn It Live webinars on particular instruments or indicators, and it's all free and there for you. So, and if you don't want to actually miss out on basically getting any of the updated information, just make sure you subscribe to the Pepperstone YouTube channel. So that way you can get alerts when something does get released. So you don't have to keep just checking it out. You'll get an alert to tell you that something new has been uploaded. And it is a very big volume library in there. So yeah, be sure to check that out. And these replays will always be in there the next day as well.
Heaps of people want to learn here, Ty, which is excellent. It's always great to see so many new traders entering the field. Here's one: is the 200 moving average simple or exponential? It is simple in this case, so absolutely certainly. Which major pairs respect support and resistance levels? Pretty much any of the major currencies. Anything that's traded heavily in volume will therefore be traded generally heavily in technical analysis. A good way to put it is Bitcoin did not used to trade very technically. It was mostly sentiment driven and aggressive moves. Nowadays, it's become more of the blue chip, I guess you would call it, of cryptocurrencies, and therefore it actually trades a lot more technically. So you'll find that as a currency matures and becomes higher volume, then you will have better TA. So pretty much Euro, US dollar, most of the US dollar majors, anything that makes up the dollar index, if you check that out, those types of things. You are correct, Adelio. Yep, absolutely with your thing. And there's quite a few other questions that are coming in. So thank you very much for attending today. We really appreciate it. Great to see so much great feedback.
Great turnout.
Please do fill in the survey.
Thank you.
We have to do more of these types of things. And as I said, I will want to do eventually a VWAP indicator for everyone as well. So we're using the MetaTrader 5 platform for Pepperstone tonight. And that was the one we were doing on the analysis in. And you can see it's quite easy to use and it's a great platform. So best of luck, everyone, this week. We hope everybody has success. And obviously, volatility is set to continue into the US elections. So we'll have to watch and see how the markets react to all of that. Thank you very much for both Tyron and I, and we'll see you.
Definitely. In 2 weeks. Thanks very much. And just don't forget about that survey, guys. It'll really help us out. Thank you.
Thanks very much. Bye.